On June 12th, the biggest stock market debut in history finally happened. Millions of retail investors rushed to buy the SpaceX IPO, driven by pure fear of missing out and breathless financial headlines. If you were one of the people who sat back, looked at the $1.77 trillion valuation, and decided to pass, you probably felt pretty smart. You exercised restraint. You kept your money safe in your boring, reliable, passive index funds. Here's the uncomfortable truth. Wall Street is about to force you to buy SpaceX anyway, and they are going to do it automatically using your retirement money, regardless of the price. Most people think passive investing insulates them from IPO mania. But behind closed doors, the people who design the market's biggest index funds have quietly rewritten their own rules. They have engineered a fast-track system designed specifically to vacuum your passive money into this newly public stock. So before you pat yourself on the back for avoiding the day one trap, let's pull apart the mechanics of the index fund hijack. To understand how you are being forced into this trade, you first must understand how a passive index fund actually works. When you buy a Nasdaq 100 ETF or a broad Russell 1000 fund, you are handing your money over to an algorithm. That algorithm blindly buys whatever companies the index provider dictates. Historically, getting into these elite benchmark indexes was hard. A newly public company had to trade for months, proving its stability before the algorithm was allowed to touch it. There were strict, non-negotiable rules about minimum public float, meaning a large, healthy percentage of the company's shares actually had to be available for public trading. SpaceX breaks almost all of those traditional rules. At its IPO, only a tiny fraction of its total shares were made available to the public. The vast majority of the company is locked up by insiders, founders, and early private investors. Under the old rules, this incredibly low float would have completely disqualified SpaceX from entering the major index funds. But Wall Street does not like to miss out on management fees. So, they changed the rules. FTSE Russell introduced a brand new fast entry rule. Instead of waiting for their standard, scheduled quarterly rebalance, massive IPOs can now be shoved into the Russell indexes after just 5 days of public trading. Nasdaq went even further. They eliminated their old 10% minimum float requirement entirely. They created a special fast inclusion framework that allows a mega-cap company like SpaceX to bypass the old waiting period and enter the flagship Nasdaq 100 index in exactly 15 trading days. Let that sink in. 15 days. Nasdaq even created a multiplier rule that artificially triples the weighting of SpaceX's tiny free float inside the index, just to give it more prominence. They literally bent their own institutional rules to rush this stock into the portfolios of millions of passive investors. So, what happens when an algorithm is suddenly told to add a $1.77 trillion company to its list? It cannot just invent new money out of thin air. The moment SpaceX is officially added to the Nasdaq 100, every single passive fund tracking that index has to buy the stock immediately, blindly. Since these funds don't have billions of dollars of spare cash sitting around, they must sell other assets to make room. These algorithms will automatically sell off fractions of highly profitable, established companies like Apple, Microsoft, and Nvidia, just to free up the cash to buy SpaceX at whatever price it happens to be trading at. Hundreds of billions of dollars are pegged to these indexes. When the inclusion trigger is pulled, a massive wave of forced, price-insensitive buying hits the open market. The index funds do not care if the stock is wildly overvalued. They do not care that independent research firms like Morningstar have pegged the fair value at roughly $63 a share, less than half of the $135 IPO price. The passive funds just execute the trade. This forced buying creates an artificial spike in demand, driving the stock price up simply because the structural plumbing demands it. If you want proof of how highly manufactured this rule change is, look at the one index provider that refused to play along. Standard & Poor's, the company behind the S&P 500, looked at the SpaceX IPO and firmly held its ground. They declined to change their strict inclusion rules for one company. To get into the S&P 500, a company must trade publicly for a full 12 months. It must have a minimum 10% public float. And critically, it must demonstrate 4 consecutive quarters of cumulative profitability. SpaceX fails two of those three tests right out of the gate. By refusing to bend their methodology, the S&P 500 protects its investors from the immediate chaos and extreme premium of the IPO. If you own an S&P 500 index fund, your money is structurally protected for at least a year. This is the ultimate sanity check. One index bends the rules to rush the stock into your portfolio in 15 days, while the other demands 12 full months of proven financial performance. This tells you exactly what kind of game is being played. So why the rush? Why force the stock into the Nasdaq 100 so quickly? This is where the quiet math gets truly dark. The vast majority of SpaceX shares are held by private insiders who have been waiting years for this exact liquidity event. But they cannot sell on day one. They are bound by lockup agreements designed to prevent the stock from crashing. But those lockup periods open up in staggered windows. If the insider dam breaks and millions of shares flood the open market, the price will collapse, unless there is a massive pool of guaranteed buyers waiting on the other side. Enter the passive index fund investor. By rewriting the rules to fast-track SpaceX into the indexes, Wall Street guarantees a massive, steady flow of automatic buying. Your retirement account becomes the artificial floor. The passive funds blindly buy the stock, propping up the price just in time for the early investors and private equity firms to cash out. You are acting as exit liquidity. The rules were rewritten so that your 401k could absorb the risk while the insiders take the profit. So what is the rational response to a market that is actively trying to hijack your passive investments? You stop being completely passive. You need to run an audit on your own portfolio today. Do you know exactly which benchmark your target date index funds track? If you hold a NASDAQ 100 ETF or a broad market Russell fund, you are about to become a forced buyer of SpaceX. If you hold an S&P 500 fund, you are insulated for now. The financial headlines want you completely focused on rockets, satellites, and AI integration. But the real wealth transfer is happening in the boring, highly technical plumbing of index inclusion rules. Do not let your retirement money be used as a shock absorber for Wall Street's biggest payday. Take control of your allocations. Subscribe to strip away the narrative, and I will see you in the next one.